Hello and welcome everybody to this XTB video. My name is Walid Kudmani, Chief Market Analyst for XTB. And in this video, we're going to be covering a very important topic these days, which is inflation and the impact that commodities have on inflation. So we're going to go through some slides and hopefully we're going to be able to explain where this inflation is coming from, how much of an impact commodities are having, which way the cycle is going, whether commodities are impacting inflation or vice versa. And it might turn out to be a mix of both. So hopefully this video is going to be informative. It's going to be quite short and to the point. So if you have any questions, leave them in the comments below. Hopefully we'll be able to reach some sort of an answer with the next videos we'll be doing in the coming days as well. So hopefully this is useful and let's get right to it. So the topic of today is how do commodities affect inflation? And as always, this presentation is provided for general information and marketing purposes only. I'll give you a few seconds to read the disclaimer and risk warning. And so let's start with, are commodities the main causes of inflation? For an extended period of time, central banks tried to stimulate price growth. We've seen that throughout the past decade or so, mainly through higher wages. So we've seen an increase in wages, which is generally going to lead to higher inflation, higher price growth. The inflation targets were more than achieved, unfortunately mainly through supply factors. It is sometimes difficult to answer the question whether high inflation is caused by rising commodity prices, or rather high inflation causes an increase in commodity prices. Currently, we can quite clearly state that the rising commodity prices cause the ubiquitous increase in prices of all products. Now, the causes of this have been quite widespread. Some of them you may understand from watching the news. You see supply issues with oil from Russia, wheat supply issues from Ukraine, as they are some of the major exporters. We also see some other prices based on other commodities around the world. For example, you see a negative weather report from Brazil, where they produce a lot of coffee or cocoa, and then you see how that might be impacting the price as well. So supply is definitely having a significant impact on the price of commodities. And then certain commodities, which we'll be covering shortly, have an impact which relates onto all other sectors of the economy, which is why they can then lead to general inflation. The direct impact of commodity prices on inflation. In the analysis of the contribution of consumer inflation, we chose those categories. This is based on some research we've done at XTB that can easily and directly be linked with the corresponding commodity prices. So that way we can see a correlation of some sort. Of course, price changes in these categories also depend on other factors, such as labor costs, which have been going up, especially after the recovery post-pandemic, which has been occurring in the majority of the world. However, it cannot be denied that the recent rise in the importance of these categories is primarily the result of rising commodity prices. Last year, many classes of raw materials increased by several dozen percent in prices, so it should not be surprising that the selected categories have gained huge importance. Now, furthermore, in the United States, the joint contribution of these categories accounts for 0.1 percent point to the average inflation of 2%. In the euro area, the impact of raw materials categories over the last 10 years is around 0.3%, with around the average inflation at 1.3%. Analyzing the above data, one can reach similar conclusions to other economists. Commodities have limited impact on inflation in the long term. So in the short term, they're definitely having a significant impact on inflation. In the longer term, that's when things start to change slightly. Looking from the long-term perspective, the impact of categories such as bread, grain, meat, coffee, home energy, and fuel for transport is negligible. So that's something to keep an eye on moving forward. By the way, apologies if you can't see the bottom right of the corner because my camera is there, but basically sometimes I'm reading some of these bullet points as well. So if something is unclear, hopefully I'm clarifying it by voice. So as I said, in the short term, these inflation figures are definitely being impacted by commodities. However, if we look at the data, as I'm going to show you in a second, in the long term, the impact of these is negligible. That's considering how I'm going to explain later, the cycles of commodity prices are generally quite long. So things appear to have changed though. Energy resources have the largest share, both those for domestic use and those used to produce electricity and heat. Producer inflation in this category increased nearly 100% on an annual basis. So we saw a 100% increase basically in prices. Agricultural commodity categories are less important in the overall inflation reading, but their contribution increased several times compared to the long-term average. The impact of domestic energy prices in the US is much smaller than in the euro area, but this may be due to the way in which the categories are defined, and also probably due to the fact that the impact of the Ukraine-Russia conflict is having a much higher impact on the European economy rather than the US economy, of course, for geographical reasons particularly. In the United States, the category of shelter, mainly rental costs, has increased sharply, which indirectly also shows a significant increase in energy prices. If we look at the last 12 months, and especially data for March, the selected commodity categories account for around 50 to 60% of inflation for the Eurozone, while for the US it's around 30%. What else is worth paying attention to? We're going to cover that. But as you can see, if we look at the short-term data, a huge part of this inflation is being caused by these commodities. So it's the other way around. Rather than inflation bringing commodities up, it's commodities bringing inflation up in the short term. And particularly in the euro area, because of reasons that we've discussed in the past, also that you can imagine are related to the ongoing conflict and the difference that now we've seen from central banks, where the Fed is being more aggressive to kind of try and halt this rise in prices by increasing, especially we saw that just this week with another interest rate increase. And while this European Central Bank has had to be more cautious because of their economies are more fragile at the moment, and they've had to divert that towards the end of the year, potentially. Now, let's talk about the indirect price impact of commodity prices on inflation. So here we have the chart with the CPI and PPI, so Consumer Price Index, Producer Price Index. The indirect impact of commodity prices on inflation in the long term is rather limited, while in the short term it is much more important. However, it should be remembered that commodity prices, and in particular energy commodity prices, natural gas, oil, diesel, these ones, have a powerful indirect impact on costs for almost every sector of the economy. We've touched on this in other webinars we've done. I've talked about this at length. You can find the analysis on this in the X station as well. It's because everything is related to the energy costs of producing something. Generally speaking, as I'm going to touch on in a second, sometimes these costs can be mitigated rather than reaching the consumer. But at the moment, we are seeing a situation where they are not being mitigated. For example, energy is a significant cost of bread production as well as its transport. So you have to produce the bread using energy and then transport it using other energy. All these costs of rising energy then go into the final cost of bread, even though wheat might not be changing as a cost, even though it is, but let's say it isn't, the other factors in it are then impacting the final price that the consumer pays. Another example is coffee, which is often transported from South America, Africa, or Asia to the other side of the world. And forgetting about the COVID situation, which rendered transport almost impossible for a while, then we saw shipping prices go increasingly high and skyrocket. We saw then energy prices skyrocket as well. Tie that all together, even if the price of coffee itself doesn't increase at the point of production, by the time it reaches the consumer in the West, or let's say in Europe or in the US, then the whole value added cost that gets added onto it is a result of this inflation caused by other commodities, which is the indirect inflation. Producer inflation, where the impact of commodities is higher, is much more volatile. Highly expensive raw materials may force producers to pass on costs to consumers to even a greater extent. In fact, so some further points to this. There could be endless examples of where energy is needed for transportation. Jerome Powell, who is the Federal Reserve head, recently pointed out during the hearing before Congress that every time oil price rises by $10 per barrel, it adds 0.2 percentage points to inflation, based on their calculations. We would like to point out that in addition to energy and food, the prices of industrial metals, which are the backbone of construction, of infrastructure and means of transport, are also rising. For example, it is estimated that the prices of steel, copper, aluminum, and nickel account for 10% of all car production costs. As you would imagine, many of these metals are used in the car production costs. Many of these metals are increasing in prices. Some of them are produced by Russia. Some of them are being imported extensively from China. So with the recovery that's going on there, the prices increase further. All of this ties into higher prices for the consumer in the end. It is worth remembering that in the case of a healthy economy, higher commodity prices may not necessarily translate into an increase in the price of the final product. It is related to the scale effect. So as you may know, mass scale production allows for individual components and individual parts to be cheaper because you're buying in bulk. Each one starts to cost less, and then the consumer ends up paying basically the same amount for a better product, more, or let's say, even if the producer is paying a little bit more. In addition, producers do not always pass on all costs to consumers. In other words, if the price of nickel or zinc rises by 100%, so doubles, but the economy is stable, then there is a good chance that companies will not pass the cost on to consumers in order to avoid their negative reaction, because consumers might find an alternative or might choose not to spend that money anymore. However, when all commodities are expensive and at the same time demand is strong, which is a key here because we are seeing the rise in demand, because if this had been happening, as you saw during the pandemic, oil production was still the same. Let's say oil prices went up, but nobody was buying oil, so that led to the crash of oil prices. Even some of you may remember the negative territory that WTI reached for a while, where basically producers were begging just to deliver that oil. When all commodities are expensive, at the same time demand is strong, companies will at some point try to remain profitable, even at the cost of losing buyers. Even though, as we mentioned, buyers are having to deal with these because you have heating, you have energy costs, you have jobs starting back again. How are the consumers going to deal with this? They have to adjust. So the question remains, how long could this situation, stay the way it is, and how long could the upward move last on these prices? So commodity growth cycles can last for even 10 years. So theoretically, the recent bottom occurred at the beginning of the pandemic in March 2020, when I'm just talking about the oil crash and several other commodities as well. This would mean that we are only at the very beginning of the uptrend. Of course, rampant inflation can also lead to a recession, which could push commodities prices lower, because a recession would, by definition, then entail much lower demand because consumers can't afford to pay for anything. They can't buy anything. So at that point, the laws of demand supply start to equalize. Another factor to watch out for are rising interest rates. Rising interest rates would be lowering demand artificially by increasing the cost of money. The less money there is in circulation, the less producers can charge, and the less consumers can actually pay. And here we see on the left, thanks to Bloomberg and XTB research, the share of energy commodities in the global GDP is really high and has been growing in recent years, which indicates that changes in the prices of this asset class may have a significant impact on the inflation in the near future. The prices of some commodities are approaching their all-time highs. However, the most important ones are still well below their record levels. And here we can see how far the price is from the all-time high, roughly about 44%, natural gas about 125%, wheat about 23%, corn 4.46%, aluminum 31.81%, gold and copper still around 10% almost. And as you can see, oil accounts for a significant part of global GDP, and natural gas. So these are the two main ones that are being impacted also by the conflict at the moment. We saw some hope from the US trying to reach a deal with Venezuela, with Iran for some more oil supplies. But OPEC at the same time is not increasing production. They're still agreeing on their 400,000 barrel increase because they're trying to make up some of that money that they lost in the crash. So as long as producers find it profitable to sell at a certain level and people are buying, they are not incentivized at that point to then adjust their supply. If then we enter recession territory, we might see things change. If we don't, then potentially we could be at the beginning of a cycle that lasts around 10 years, but there's many factors to keep an eye on moving forward. So hopefully in this brief video, we've kind of outlined all the factors that go into inflation on the commodity side, how this cycle of inflation is being driven by the commodity prices, even though there are many factors, including the unprecedented fiscal and monetary policies that we saw from central banks and other factors as well. All of these are playing into the bigger picture of the consumers at the end up paying much higher prices in an unhealthy economy, which is potentially moving into scenarios of recession or stagflation across Western countries. So hopefully this was useful. My name is Walid Kudmani, Chief Market Analyst for XTB. If you have any more questions, please leave them below in the comments. We'll try to get to them in a future video. If you enjoyed the video, please leave a like, subscribe to the channel, and hopefully we'll see you in the next one. Thank you very much. Good luck with your trading.